Yes, my people, hope you are well. Welcome back to the Ground Zero series. This is episode 2. We'll be going over trade executions. The last video, we was going over the introduction into the market, pretty much going over the basics of what the Forex market is and what you're trading, who's in the market, etc. But today, the 4 questions we're going to be answering is: what is a pip in Forex? What is a lot in Forex? What is a spread, or what is spread in Forex, and what are the different types of orders in Forex? Okay, and again, these are very needed to understand. A lot of people don't actually understand what a pip is, but are still using pips to actually trade, you know what I'm saying? So make sure we have this understanding before we obviously continue on. So what is a pip? A pip is a tiny measurement of price movement in the Forex market. Think of it as the smallest step a currency pair can take. For example, imagine Euro USD is at 1.1 and moves to 1.1001. That 0.0001 change is 1 pip. How are pips measured? Most currency pairs are quoted to 4 decimal places, right? So you'll see all of your pairs pretty much decimal point, and then you got four points after. A 1 pip move would obviously be the last digit, but a little bit different for Japanese pairs because they've only got 2 decimal points. You'll see that the currency is much higher. So instead of 1 point something, it will be a higher figure, for normally a 3 to 2 figure number, and then point something something. So it's a 2 decimal place with Japanese yen, but a lot of you guys who are trading London session are probably just trading EU, GU and EG, which will have 4 decimal places. Why do pips matter? They used to set stop losses and take profits. Again, pips matter because when we're using a lot size calculator, which we'll get into in the 4th video, or the 3rd episode I think, is that you need to actually know what how many pips your stop loss is in order to actually dictate the lot size for your trade. So very, very important. They make it easy to compare price movements across different trades. So quick recap: pips are tiny price movements in Forex. Most pairs use 4 decimal places except JPY, they use 2. More pips equals more potential profit or loss. What is a lot size? A lot size is how much of a currency you're trading. Think of it as like buying fruit. A standard lot is like buying a big bag of apples, more risk, more reward. A mini lot is like buying a medium bag, smaller, more manageable. A micro lot is buying just a few apples, low risk, great for beginners. So this is going over the obviously account types you can have on a normal retail brokerage accounts. So you've got the standard lot, okay, mini lot, micro lot, nano lot. A lot of people that will be trading funded accounts will just be using the standard lot, but for people who are trading smaller money, say for example, well, like we just said here, great for beginners. Say if you're a beginner, you just want to open up a small, say $10 account, you can trade essentially cent lots. These are normally called cent accounts. I mean, I'll get into that. I think we've actually got that on the next slide. But yeah, if you're trading on standard lot, you've probably got a much bigger account size, and obviously you can make more money. But there's higher risk, of course. And then moving down towards the nano lot, where you could be risking a cent per lot. So more money to be made, low risk, but at the same time, it's very good for the learning stage. Why do lot sizes matter? Big lots equals more risk and more reward. A standard lot moves $10 per pip. A micro lot moves just 10 cents per pip. Great for beginners. Again, standards more if you're a little bit more advanced on the personal account. Micro would be better, much better if you're a beginner. Again, you've got that nano account if you want to even risk even less. Choosing the right lot size, better risk management. If you have a small account, trading micro or mini lots helps control losses. Bigger traders with large accounts can use standard lots for bigger profits. Lot size game analogy: standard lots playing on hard mode, mini lot on normal mode, micro lot easy mode, nano lot super safe mode. That's a good way to look at it. That's a decent analogy there. Quick recaps: lot sizes controls how much money you make or lose per pip. Standard is $10 per pip, mini is $1 per pip, micro is 10 cents. Start small, level up as you grow. That's the best way I would say advise, because again, it's always risky at the start. You're not too sure what you are fucking doing at the start, really. You are just learning. So I would say, again, realize you are in that learning phase and just start off with the small accounts, because you're not aiming to make money right now. You're aiming to learn a skill, right? So don't worry about having to try and make so much money and stuff like that. Just make sure you know you're in that learning phase. So spreads in trading. What is a spread? A spread is the difference between the bid price and the ask price in trading. Think of it as a small fee you pay to enter a trade. It's how brokers make money without charging commission. Spread analogy: imagine you're buying trainers, the shop buys them for $50, that's the bid price, the shop sells them at $55, that is their ask price, and the $5 difference is the spread, which is their profit. How is the spread measured? Again, why pips is important. It's measured in pips. Example, Euro USD, the bid price is 1.1, but the ask price is 1.12. That means the spread is 2. Why do spreads matter? Tighter spreads equals lower trading cost. 2, wider spreads equals more expensive to trade. And then 3, spreads widen during big news events and low liquidity. Another big reason why we say do not trade during red folder news, because the spreads do open heavily, especially with some retail brokers, heavily, where you could actually end up just losing your whole account if you're not safe with risk or stop losses, and it could even surpass your stop loss, which is mad, I know. Types of spreads. So it's different. There's a few different spread types. Well, a couple of spread types to be honest with you. It's just a fixed spread, so obviously always stays the same. Good for beginners. Good stable costs. Variable spread. It changes depending on the market conditions. So this is when advanced traders can actually prioritize the low spread times. Again, if you don't trade news, then you're calm. Variable spread probably is a better way. Used by advanced traders, tight in calm markets, but wider in volatile times. So if you do trade in tighter markets, there is going to be tighter spread. So that is why variable is something that I trade. But again, as a beginner, staying on fixed spread, I think is quite vital. The different order types, very important to understand. Market execution, buy sell limit, and buy sell stop. Let's get into the actual thing behind it. So limit is when you set a price better than the current market price and wait for the market to come to you. So buy limit is buy below current price. So for an example, right, it's pretty much saying that you want to buy something when it gets to a better price. So it's like you're waiting, you want to buy something, but you're waiting for it just to get that little bit cheaper. For an example here, I'll buy Euro USD if it drops to 109.50. So it's like, for an example, let me give you an analogy. Say if you're seeing a pair of Supreme trainers are probably about $210, but you're just waiting for it to come to that $170 because you want to pay that little bit less. You want to pay that little bit discount just so you can save a little bit of money. It's the exact same in terms of limit orders. And then obviously vice versa, sell limit, sell above the current price. I'll sell Euro USD if it rises to 1.1050. Stop orders. Now these are a little bit harder to understand, but it's pretty much just the opposite. So a stop order is used to enter a trade once the price moves in a certain direction. This is for breakout traders. We do not trade breakout. If you do trade breakout, this is probably what you would be using, or market executions. So buy stop, buy above current price. So again, it's literally the complete opposite of a limit order. I'll buy Euro USD if it breaks above 1.105. So it's pretty much like saying, I mean, you wouldn't use this for a trainer perspective, but I'll use this in a different perspective for a different analogy. Say, for an example, right, I say, I have these Supreme trainers. I've got them for $200, but I want to wait until they get to a higher price, and that's when I'll sell them. That's pretty much what you're doing. That would be what your sell stop would be. So I'll sell if USD drops to below 1.105. So it pretty much is the same thing looking at that perspective. So why do we use limits and stops? Not every trader wants to enter the market right away. Sometimes you want to wait for a better price, automatically enter when price breaks out, and avoid staring at the chart all day. That is the exact reason why I trade limits, because I want to wait for a better price. 2, I don't actually want to be fucking staring at the charts for hours and then take my trade. Plus, it can automatically do it for me. If I've got it all set up in the morning, and then, say for an example, it hits the limit in about an hour's time, that'll be perfectly fine. That's where limit and stop orders come in. Setting traps versus chasing trends. So again, this is still on limit versus loss. Stop, sorry. Limit order, wait for price to come to you. Stop order, enter when price moves in your direction. So it's pretty much like jumping on a train. Well, I just realised I've got analogies there. But yeah, the top analogy is setting a fishing net. So it's the exact same thing, just waiting for price to come to that perfect point. And obviously, stop order is like you jumping on a train. That's a good analogy there. Quick recap: a buy limit, buy when price drops lower. Sell limit, sell when price rises higher. Buy stop, buy when price breaks up a certain level. Sell stop, sell when price drops below a certain level. And that is it for today's video. Again, we've gone over those 4 very important questions. What is a pip? What is a lot? What is spread? And then what are the different orders in Forex? Understanding these are very, very, very important. But appreciate you boys. That has been episode 2 on ground zero, and I appreciate you boys. The next one's on market hours and the different trading tools. Appreciate y'all.